So with mortgage rates on the rise and you're starting to see the housing market start to slow down a little bit, many people are wondering, is this a repeat of 2008? We'll look at this article to see, really, is this another repeat of the housing crash? Are we going to have another crisis on our hands? Let's take a look at some of these charts right here. Okay, this article by Sam Rowe here talks about 3 charts that shows that we're not repeating a housing bubble. Now, he addressed the fact that mortgage rates are on the rise. We're definitely seeing that. We're also seeing, of course, that record highs are still happening in the house prices. So it could give you that effect. But here's where there's really are 3 differences, and I'll even add a few of my own too. Number 1, okay, mortgage originations by credit score. During the last recession, and I remember I was a mortgage broker in 2006, especially 2007. I remember what lending practices were like. Almost anybody that wanted to get a mortgage could get a mortgage, right? We had what was called subprime lending. Generally, the better credit score of like 680 and above, that's usually what banks will lend for. But then they also had these ones where if you had below a 680 or below a 660 or even below a 620 credit score, you could still get a mortgage. Why? Because the sky was the limit. The banks started really cashing in on the greed that was going on in the marketplace. There was definitely mortgage rates were fine. They were coming lower, so people could still afford the payments, even if you charged them more interest. So banks started to focus more on what was called subprime mortgages for people that had scores, especially below 620. Well, as you know, history said things didn't work out so well. Even for those with great credit scores, still had a hard time with the mortgages to be able to make those back, especially as things got tighter. Banks tightened up like crazy, and it got worse. So if you look at this chart here, this is showing the mortgage originations by credit score. So the mortgage application that you're seeing, what are they by credit score? Now, what you don't want to see is you don't want to see dark blue and kind of this gold yellowish color. Those are really the kind of the barely prime to subprime type loans. And notice you'll see back here, and they're showing all the way back to 2003, 2004, 6, 7. And then it comes crashing down after 8 and 9. And then you see it's almost like just about bottom, right near zero. It came up a little bit in the last few years, but notice how much lower it is than it was like in 2006, 2007, where it was up to almost to that 200 mark. That's $200 billion of lending, right? Where now it's kind of negligible. I can't even tell how much it is. I would say it's definitely probably less than 30, $40 million or $1 billion of lending. So that's one. They're not doing as much subprime mortgages. They're being very strict. This is something I've said on my podcast for several years now, that this is not a repeat because banks aren't lending to just anybody. Even for us, where we have good credit scores, we have lots of cash, everything should be perfect. You still feel like you're being interrogated, like the lights coming in on you, and you're being asked, like, did you do it? Did you murder them? No, I didn't. That's what it feels like, right? That's kind of what's going on. So more lenders are not being overly aggressive. They're not, creating all these different little cute little mortgage programs or negative AM arms. I actually remember offering those to people before, where you could actually pay less than interest only payments. And that kind of leads to this next one, which is the percentage of people in adjustable loans, right? These ARM type of loans. I'm not talking about necessarily just like the fixed ARMs, right? Although that's starting to be on the rise a little bit more lately. There's some fixed ARMs that you can lock in the rate for 5, maybe 7 years or so. But we're talking about more like the 1-year ARMs. Now notice, check this out. I mean, of course, the 90s, there was a spike in them, but look here, 2005, 2006, right? It was up about a third. And I can attest to that. Like, they were very popular. We were teaching them around the financial advisor's office. Everybody's like, these are cool because you got a 4-payment option. You can pay a 15-year mortgage payment, a 30-year mortgage payment, an interest-only mortgage payment, or less than interest-only mortgage payment. You can pay whatever you want. So you can actually watch it go up because, again, they thought prices would keep going up. So you don't have to pay the full amount of interest. You can let the balance increase on you. That was a big risky move. And they came crashing down in 2009. And notice, even when they came back a little bit there, in the 5 to 8% range in the 2010s, they really didn't do much. And look, even when it goes into 2020, boom, they even crashed lower. That means the banks even got more strict on doing these adjustable loans. Now it says roughly right about 5%. So again, that's another difference there. It's not having these people that get this cash crunch. And that leads to this third chart, which is how many people have fixed interest rates and at what percentage? Look, I mean, you've got right here, right up between 2.75 and 3%. You got 16% right there. Really, between 2.75 and 3%, you got about a third of people between that period, like really between 2.75 and 3.25. You got more than a third of Americans already in that place. So that's a big difference. People got their rates locked in low. Now, that could be a risk down the road if they want to refinance again and they have to refinance at a higher rate. You can already see here. Now, this rate's, of course, up through about August, September. So that's why you don't see as many sixes. You're going to see more of those now. But still, people are keeping the rates, they're locking in, which is preventing people from wanting to do a lot of moving and selling and things of that nature. So it always comes back to what's going on, what's happening with credit. Are people really moving money around? And the difference is that it's not. Like, really, what we're seeing right now is that the mortgage market isn't going crazy. Okay. I will also add to this, in addition to what they have shown as well, housing. One thing that I noticed back in 2005, 2006, 2007 is they were overbuilding, building beyond what was necessary. We didn't even need that much. Okay. So we went beyond what the population actually needed. And that created a lot of vacant properties. It created a lot of foreclosures because of that reason alone. Even if they could afford it, there was nobody to rent them. This wasn't as bad as China, where you have entire cities and towns vacant, right? It's not like that. But it just, there wasn't that demand. This time around, especially with 2020, 2021, even though people were begging to build homes because of the supply crisis, it actually tempered it some more. So as a result, they didn't build as much. Now they're trying to play catch up because prices of lumber, especially, have come down. Now they're trying to play catch up, but we've had a massive, for really the last 10 years, over a decade, we've had this massive housing shortage. This is why I'm starting to hear a lot of investors talking about building affordable type of multifamily housing instead, because people just haven't been able to build houses enough. And now with rising prices and rising interest rates, it's making it tougher. So as a result of the Feds now rising interest rates so quickly, right? Because remember, we went to that crisis, although they were raising rates a little bit, but they kind of kept rates pretty low, even going to 2007. Pretty quickly, they're lowering rates because they saw we're moving into a big recession. Here, we're not doing that. They are aggressively rising interest rates, which means that one of two things have to happen. Either one, people just eat the cost. They just keep, saying, all right, I got to take it whatever for whatever it is. Maybe prices will come down a little bit, but maybe they won't, because again, the builders have to make a certain amount of profit for it to work. So they're going to likely either have to eat the costs and pay more money for that home, or they start moving into rentals instead. They start changing their mind and moving that direction, which I'm seeing happen. If you're a real estate investor, this is good news, because if you have a rental and people start giving up on their idea of buying a home and then they go back to renting again, this drives up demand for you. This did happen in the last housing crisis. The housing crisis was caused by the credit markets freezing up. The credit markets are not freezing up right now, but because the interest rates are going up so high, they don't have to really freeze the credit market. They realize, look, we can actually just get people to not want to buy homes just by raising interest rates high enough. They'll stop. And what does it mean? That if people wanted to buy homes and now they're no longer in the market because they got priced out of it, they move right back to your rentals. That will drive rental prices up just like it did before. So right now, temporarily, we haven't seen that big boost, but I think you're going to see that more and more, especially because interest rates have just more recently, just in the last few months, skyrocketed so much that it's now getting people out of the market and starting to look for other alternatives, other options. So if you want to profit from this, you want to be able to profit from this kind of thing here, this is the perfect opportunity to say, I should be buying real estate. Now you may not want to be buying, you may or may not want to buy with financing. You might be buying outright in cash because those rates are getting so high. There might be other financing alternatives you look at, but right now, this could be the perfect time to get into real estate investing, whether it's in multifamily, even though that's starting to build up again, or it's moving to single family homes. There are definitely some alternatives there. Now, guys, if you like this video at all, hit like, subscribe. I love to hear your comments. What do you think is going on? Do you think this is like the last housing bubble? Or do you think something's new here? Something new is happening? Maybe something dangerous around the corner? I would love to hear your comments and your thoughts. Put those in the comments below. And if you like this video, check out our other video. Is the real estate market about to drop? Well, check out our video and see our answer on that one right now.